Welcome back to another Tech Talk from MarketEdge.com, your source for unbiased technical stock research on over 5,000 stocks and ETFs. My name's Rachel, and with me today is David Blake, CMT, here to discuss what happened in the market last week and what we should look for as we head into this week. David, how's it going today?
I'm doing well, thank you.
Great, let's jump right in.
Okay, we'll get into that summer sluggish kind of trading that we usually get in August. A lot of times we'll see the choppy trading coming in here. But as the week started, went into Tuesday, the major averages did struggle a little bit. First off, we had the stalled talks between the U.S. and Iran, led to another surge in oil prices on Monday. And then on Tuesday, investors were kind of marking time while they waited for the inflation data to come in, the July CPI and July PPI. Fortunately, we got some below expected numbers on that. The July CPI came in right in line. It was up 0.1% and 3.4% year over year. And then we had on Thursday, we had the PPI come in, and it was unchanged for July. And then although it was 4.7% year over year, that was also a tick below what they were looking for. So that kind of triggered a little bit of a rally. Investors came back in. We also on that Wednesday had earnings from CoreWeave and Nebius Group, which they're helping to build some of this AI infrastructure stuff. And those two stocks handily beat earnings. They were up, I think, 15%. I think Nebius was up something like 20-some% after earnings. They helped provide chip makers with a rally. The semiconductor index, SOX, was up about 2.5% that day. So we had a nice rally, midweek. And then as we rolled into the weekend, we just kind of had another kind of a choppy day. We started up higher and kind of worked our way a little bit lower. We had July retail sales that actually fell 0.6%. I think we were looking for something like up 2 or 3/10. And that was something that bothered traders a little bit because, as I mentioned before, the retail consumer is one of the reasons why earnings are so good. And it's been a little bit surprising as we've seen the higher gasoline prices, higher food prices, inflation's been a little bit stubborn, but the consumer has still been spending, and that's a good sign for the market. So we'll have to see. That bothered people a little bit on Friday, with that drop in July retail sales. Okay, at the end of the week now, we had crude oil prices. They were higher from the Monday spike. I think they went about 82.29 barrel. And then we had yields were actually mixed. We're getting the longer yields, like the 10 to 30, moving higher, while the 2-year has been ticking a little bit lower. Now, the good part of that is it's a good reason to be in the financial stocks because that yield curve spread has been expanding. I mentioned that a couple of times last week. We also saw Bank of America, JP Morgan, Charles Schwab, a lot of other banks making new highs. And in fact, the financial sector ETF XLF also made a new high last week. So it's not a sexy kind of investment, when you're buying into banks, but in the whole sector, ETF is making a new high. That's something you got to be aware of. And with the spread widening as it's been, that's a good place to be right now is, in some of the banking stocks. So keep that in mind. Okay, the technical condition of the market, it did improve last week, not a lot because we had some up and down choppy trading, but we did see new highs hit by the S&P 500, the equal weight S&P 500, the NYSE, and the Russell 2000. And I mentioned in the comment that we're also seeing new highs in the mid-cap growth ETFs. That's kind of important. These are all rated long by MarketEdge. We had the S&P mid-cap growth, which is IJK, the Russell mid-cap growth, IWP, and the Vanguard mid-cap growth, VOT, all hitting new highs last week. And I'll show you the charts on those in just a couple of minutes here. Technical indicators right now for the different indexes are pretty much in bullish ground. One exception is with the Dow Jones, and I want to pull this up. But, a lot of technicians, we look for patterns in the stocks and indexes and stuff like that. This is DIA. That's the Dow Jones. But this is the diamond. I want to bring it in here a little bit. As you can see, it came down here. We bounced off the 50-day moving average, and we had this big breakout up here. Now, this is called a flag pattern. As you can see, it's easy to recognize. You have a nice sharp move up to the upside down, and then you have a little bit of a pullback, which kind of resembles a flag. You put trend lines in here. You can go like this and then draw another one down here like this. You have a little bit of a flag. And then what normally happens with this is you get a breakout to the upside. Now, there's something that you can do yourself. If you take your fingers, you can't see me, but if you take your thumb and put it right about here, which is just, let's say 517, and then you go up to where the flag pattern starts. In this case, it was 540. So you're looking at 23 points. When this thing breaks out to the upside, which you probably should do in the next day or two, if you take this right over here, which is, let's say 540 again, and you add the 23 points, that's going to give you a target off of this pattern of about 563 on the diamond with the DIA. And that's normally how technicians will measure these things. And that would be once we get the breakout to the upside on this flag pattern, we'll see that. Another thing that you can look at also, what's perfect on these things is while we get this little bit of a pullback, it's looked at as a pause and a rally. The fact that it comes back on lower breadth, as you can see right here, the volume was lower as it's pulling back. That means people aren't really anxious to sell it. They're just maybe a little bit of some people trading it as we take a pause. That's basically textbook flag pattern. Spike up, you pull back on lower volume, and then you break out to the upside and volume starts to pick up again. So that's something you can look at, which pretty much kind of confirms to me that we'll probably see another leg up here probably pretty soon. Going on from there, we talked about some of these mid caps. Here's IJK. Again, here you can see this. It's also participating, had the big breakout, bounced off the 100-day moving average, and now we're breaking out up here. That's a new high. Here's the Russell mid cap growth. Again, we have another one breaking out to a new high. And then finally, the Vanguard mid cap, that's VOT. Again, another one making a new high on that thing. As you can see, the opinions on these are long. So that's something that you can probably ride with. And we've been long that with MarketEdge, somewhere over here around April 19th, so somewhere right around in here when we broke through the average. So you've had a nice trade on that if you've been following that, or you've been looking at some of your watch lists if you have those in. Going back to the home page here. Okay, the other thing I've mentioned several times is when you have a breakout in these markets, like what we have in the last week or two, you want to see, especially the NYSE advanced decline line, making new highs. Okay, that confirms that most of the stocks are under accumulation and they're rolling. You shouldn't miss this. The fact that we're making new highs and the AD line is, also making new highs. That's a big confirmation signal for traders and for investors that we've got a little bit further to go. Normally what you will see when you have a pullback in the market, you will see this actually peak 2, 3, 4 weeks sometimes before the actual market peaks. In other words, you have the momentum going up here, but then the AD line starts to kind of go sideways and maybe start to go lower while the index itself is going higher. That's generally what traders will look for a sign that, okay, we're probably running out of gas here a little bit. And then you'll also look at the NASDAQ, but had that big pull back. A lot of this was on semis and that kind of stuff because they were down 17%. They were down 20%. And that semis have rallied 17% from this point up. You can see it's had a big spike in the AD line to it. The NASDAQ AD line isn't as important as the NYSE because there's a little bit more speculative stocks in there. Now, we've also seen a little bit more of a breakout, or outperformance, I should say, in the Russell and also in the transports and the Philadelphia Semiconductor Index. And I actually got an email the other day. Someone asked me, why do you consider those secondary index important as far as what direction the market's going? And the reason that we do that is because when you're buying small cap stocks and a little bit more semiconductors, that type of thing, those are more speculative investments. That's not Microsoft, it's not Kimberly-Clark, it's not Exxon. And when people are buying more speculative positions, that's another signal if you're an investor that, okay, people are getting, they think we're going higher, and if those indexes are outperforming, it's just another good sign that we're doing it. So the other side of that is you'll see those indexes pull the market down. If they're going down more than the regular market and ahead of the major indexes, that means that the big investors are starting to sell some of those speculative positions, and that's what's probably going to pull the market down going forward. Okay, finally, I just want to touch base on sentiment. We did have the consumer sentiment index came out, the University of Michigan sentiment index came out on Friday. It was a little bit low too. Again, this is kind of looking at the consumers, and it was at 51. They were looking for 55, and that was real low for that. They were looking for 55, 58 over the last couple of months, and that's just kind of showing you maybe the consumers getting a little bit more worried here over the last week or two. So we'll kind of look at that. The professionals are pretty much all in at this stage. The National Association of Active Investment Managers came in last week at 95.5 or something like that. 95.5. So they're basically all in, the institutional players and hedge funds. And that's up from 76% when we called off the thing a couple of weeks ago. The drop down, they only had 79% exposure in stocks and stuff. So again, they're looking good. Sentiment, it's not overly bullish, but it's getting there. It's just a little bit of rather than a red flag, it's a little bit more of a caution sign. Okay, now coming up this week, not a real lot going on. It's kind of a light economic week. Earnings are pretty much winding down. But this week, in conjunction with the July retail sales, you want to watch because we get Home Depot, I think, tomorrow. And then on Wednesday, we have Estee Lauder, Lowe's, Target, TJ Maxx, Ross Stores, Walmart on Thursday. And we want to see if they're seeing a pullback in the consumer also. That's probably not what we want to see, but you should just be aware that the retail sales drop is a little bit of a red flag because it may mean that the consumer is kind of running out of gas or running out of money a little bit, and that would be not a good sign for the market and could lead to some choppy trading. Okay, then finally on Wednesday this week, we get the FOMC meeting minutes from the end of July. We'll see if Warsh has anything else to add to that. Remember, we did have 3 regional Federal Reserve Bank presidents dissented in favor of raising rates, whether they left them alone at 350 to 375. As we speak right now, I wish I would have written this down, but as of Friday, I think it's about 65% probability that they leave rates alone again here in September. We'll have to see it. It's kind of varied from a coin toss to leaning towards probably unchanged again in September. We'll have to see how some of the inflation data comes in and also how some of these consumer numbers come in. If the consumer's slowing down, that would probably be more of a reason for the Fed to kind of keep it on hold and see what we have going on here. So that's kind of it for the week. We'll get some manufacturing data out on Friday. Not looking for anything big. Most analysts believe that manufacturing numbers are still going to show expansion, which is what you want for the stock market. And I think at this point, with the earnings from the consumers, it might be a little bit choppy. We did end up a little bit overbought on the S&P 500 and the NASDAQ. The Dow had ended up overbought the week before, and last week it was kind of choppy. It kind of worked out that position. The stochastics came back down on the Dow to about 60. I think they were about in the 90s this week on Friday for the S&P 500 and the NASDAQ. I don't have that exactly in front of me, but I thought they were a little bit overbought. Nothing serious where you're thinking like, holy cow, this needs a rest. But in general, you might see some choppy trading in here going forward with this and kind of, consolidates a little bit. And I think our next move will be another jump to the upside. The flag pattern on the Dow is correct, as it's, has been historically, then we should get another leg up here soon. And that's about all I have for this week.
All right, very good. Thank you so much, David. If you have questions for David or anyone else on the MarketEdge team, please feel free to send us an email to support@marketedge.com or drop a comment below if you're watching on YouTube. Speaking of YouTube, a like and subscribe help us out so much, so if you enjoyed this video, please don't forget to hit that thumbs up button for us. If you would like technical analysis updated daily on over 5,000 stocks and ETFs, as well as access to these charts and second opinions that David has shown us today, feel free to check it out at marketedge.com to get started. Your first 2 weeks are free. That's it for this week, and we'll catch you next time. Thanks, David.